Hi, everybody. Welcome back. We're here with a guest. We have Mary Gilbert with Guild Mortgage, and she is going to talk to us about what's been going on in lending. And there's a whole bunch of new stuff going on. There's like information that is crazy. We all need to know about it. We're going to talk about our coffee of the month. So our coffee of the month is Starbucks. How do you have coffee one thing without Starbucks, right? So we're going to do Starbucks House Blend, one of my faves, kind of nice and mellow. One of the good ones that I like of theirs. Not fan of all of theirs, so some
are really strong.
Yeah,
you have to be
So, but this one's not so bad.
Coffee
so that's our thing. And so, Mary, kind of walk us through what got you started into lending. Tell us some stuff about you, and let's hear it.
Well, everybody needs a place to live, wouldn't you agree?
Absolutely.
So I just thought, what is a good way to help people out and something when I know that they need. I'm a huge advocate of education, so I want to make sure that everybody knows what they're getting into, what the pros and the cons are, and make sure that they're empowered to make better decisions for themselves and their families.
And what got you into lending?
It was kind of by default. I was doing insurances, investments, and then somewhat doing a little bit of lending, and I was in a terrible car accident and broke my neck and my back. And I said, you know what, I need to slow down and do just one thing, and I decided to focus on lending because, like I said, everyone needs a place to live. Yeah. Everybody needs something now, and everybody needs to be educated on how everything works.
Nice.
So I love doing that.
Nice.
Have you been with Guild the entire time that you've been in lending? Or?
No, I've actually been with Guild since October of 2014. They actually bought the company that I was working for before. Okay. And that's back when Dodd-Frank kind of kicked in, where you had a lot of compliance and a lot of other things that needed to be taken care of. So it was a marriage. It wasn't a hostile takeover, which was nice.
Yeah.
It's been a great situation.
That's good.
That's very cool.
Well, that's awesome.
Nice.
So, kind of walk us through why Guild. Like, what's Guild got going on that some of the other lenders don't?
Well, Guild is a mortgage banker. They're servicing most of their own paper. We do everything internal as well. Some of the jumbos we are not delegated to underwrite, but most everything we are delegated to write in-house, so we can make the decisions on what passes through and what needs to be having some extra conditions added before it can get passed through to a full completion of a loan.
Yeah. So you guys have a little bit open product, so it's not just if you don't fit in this box, we can't give you a loan.
This is correct.
You
yes.
have a little bit of
we have a little leeway to say this makes sense. Let's do it.
Yeah.
We're in the business to make loans, not turn them down.
Yeah.
So if we can make it work, we're going to make it work.
Okay.
Nice.
We like to hear that. So cool. So let's kind of get started. So let's talk about the differences between a second home and an investment home.
Okay. A second home has to be at least 75 miles away, which is nice. So a lot of people like to go up to Payson, Sholo, Prescott, places like that, where they can experience all 4 seasons of the year versus just here where you get hot and
not so hot.
Not so
warm.
hot.
Hot and warm.
Yes, exactly. So anyhow, the second homes are a little bit less down. If you're trying to buy something, you can get a second home for as little as 10% down.
Nice.
Okay.
Whereas with an investment property, some of them you can get for as little as 15% down at most, or 20 to 25%. It just depends on what your situation is conventionally with credit score, your debt ratio, your income, the type of property it is, things like that. Everything kind of figures into it.
So I always try to tell people if you're planning on renting it, then it has to be an investment property. You cannot be making money on your second home.
This is correct.
Okay.
And if somebody who happens to be someone who's looking out for the investor happens to stop by the house and finds out you are renting it, they can call the loan due immediately. So that's not a situation you want to get into.
That'd be tough.
Yeah.
Okay. And I hear because they kind of have that happening. Like they're really researching that stuff.
So
they're
kind of
loan fraud, right?
Exactly. It is complete loan fraud.
Yeah.
So don't lie.
Exactly.
Okay.
Just tell,
Oh, well, that's still good roll.
tell the truth. We're good.
That's right. That's right. So, okay, so that's cool.
This side of Team Barry would tell them that. I think those two would too.
I'm pretty sure they would as well. They're good people.
Why is it that you're always trying to throw us under the bus?
I'm
Scott?
throwing shade, that's all.
So huge differences, down payment, credit score, that kind of thing. The other one is you can make money on an investment property, you can't make money on that.
This
is
is
there
correct.
anything else that makes the different product?
Regarding, what do you mean by difference?
For investment properties versus the
Second home.
second homes.
The down payment is the main big thing.
Big thing. Okay.
Yeah, you may need to have different assets, different reserves for the investment properties. Once you start having more than one property, you have to have enough reserves, meaning monthly payments, to cover both mortgages just in case something happens. So if you're buying one investment property, you can have to have at least 2 to 3 months worth of reserves for every property that you own, because they want to make sure if something happens that you're not going to go
If
into
you lose
foreclosure
a
right
tenant,
away.
that makes
Okay.
sense. That
You
you
have a
still be
little
able to
grace
pay your
time.
mortgage payment.
That makes
And when
sense.
qualifying for rent, you can actually qualify with the rent if you have a tenant already coming in. However, they're only going to give you about 75% credit for that, just in case.
As far as income
Correct.
to show, so that plays into your debt to income ratio.
Correct.
Okay.
Absolutely. So if you know you're going to be getting $2,000 rent on that, we can use 75% of that in your favor.
Right.
If you know you're going
Okay.
to have a lease right away.
That makes sense.
So it helps people get into it.
And reserves, you're talking about like cash in the bank that you can show, I have this money to cover in case I lose my tenant.
Cash
That's
in the
what you
bank
mean?
or even retirement accounts if you had to
Oh,
draw
okay.
from them as well.
Okay.
Knowing that you have some sort of money that you can tap into to
To offset
become, fluid again.
Okay. That makes sense.
Yeah, and the nice thing, and we can have up to 10 finance properties with Guild.
Wow.
So
And
That's
most
quite
of
a
them are
bit.
not that many. Yeah, so that's really nice.
Mm-hmm.
So the other pieces is, so let's go back to location. An investment property could be down the street,
correct.
but a second home has to be 75 miles
At least 75 miles away.
Gotcha.
That is correct.
Okay.
Because, and it used to be we had to have a lot more documentation about, well, you're working from home. What do you mean?
Right.
But with COVID, a lot of that has changed now.
Okay.
But 75 miles away can
Is
can
the
justify a
typical.
second home.
Okay. 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 Those are all good things to know. So let's talk about the fees that the GSE are starting to implement.
Yeah, GSEs, which are government service entities, basically Fannie Mae, Freddie Mac. Their whole goal was to have in their portfolio primary residences. They're starting to get a lot more second homes and investment properties. They don't want that to happen anymore. So what they're doing is they're raising fees. And effective April 1st, that is going to go into effect where you can have up to 2% higher rates for second and investment homes. So if you're going to do something, get in now and lock in now, because
Yeah,
it's going to be going up pretty quickly.
Well, and by the time this airs, it'll already
Right.
be too late, really.
Exactly.
Yeah.
Exactly.
So, okay. Well, those are good to know.
And I mean, I'm assuming that that's part of like the whole concept of we're trying to promote home ownership
Correct.
and not multiple home ownership. Like
Correct.
trying to make sure that those services are available for people who, are buying a primary residence. Is that
And they're also trying to get more people into the market, i.e.
Got it.
private investors. So they're hoping that some private investors will come into the market to add some liquidity and hopefully
Oh.
take some of the stress off
Stress
Okay.
off of just
that. So because if you only have one egg in your basket, you want to make sure that you're very
Secure.
Secure, exactly. But if there's more people adding money to the pot, so then you can definitely
okay?
do a lot more things.
So they're thinking that since they're raising those rates, then maybe some private investors will come in and do loans for
They'll-
second homes, investment properties.
So they'll be in there adding investment money to help with the servicing of them.
Okay.
And Guild's considered a private lender, right? You guys do your own loans.
Well, yeah, we have warehouses
bit.
that we have over 70 billion in assets right now from our servicing portfolio. So we have some decent cash to help make some situations better for people.
Right.
We're also hoping that some cash products come out there too, so that people can actually buy the homes as cash, and then so that they're not losing to quote unquote cash offers. So there'll be like cash type products.
That would
for
definitely
loans.
help in this market.
So hopefully that'll be coming to fruition in the next 60 to 90 days as well.
Have you ever seen that product before?
Have not, but I've heard a lot of good things about it. So I'm hoping that it does come to fruition.
Okay.
Because it'll help a lot of people out that are trying to get into the housing market. Because you know as well as I do that
Right.
people that come in with a lot of cash are going to
Tend to get the house.
Right.
Yeah, it makes the buyer more competitive.
Yeah.
Right, exactly. And now, of course, they're going to have to be, as you know, pre-qualified and basically pre-approved
Yeah.
up front.
I would imagine
So-
because of the risk.
Right. So it's not going to be like a pre-qualification. It's going to be a full free approval.
Yeah. Here's my life. Take a look. Let me know.
But if it gives them a leg up and hoping to get an accepted offer,
Absolutely.
it's worth it.
I mean,
Oh,
you just have to do
you
what
actually
have to
go
do.
through that process anyway, right?
Exactly.
It just the timing is different.
Right,
So,
exactly.
Yeah.
So we're hoping some products like that come into the market, and hopefully we can all start doing that to help some single families get into some of these homes instead of the investors.
Yeah. Very cool.
And for first-time home buyers, you know, they're still struggling. They're just struggling out there.
They are.
So
Just takes a little longer.
it takes a little bit longer. We always tell people just make sure that you have patience because the product, the house you need is out there. We just have to find it and track it
Yep.
down. So.
And first-time home buyers, can get into single-family residence for as little as 3% down, which is nice if they haven't owned a home in at least 3 years.
Yeah.
Because that technically qualifies you as a first-time home buyer as long as you have not owned anything for 3 years. So even people that have owned stuff possibly 5-10 years ago, they can technically qualify for another
There you go.
first-time residence, which is
Yeah.
nice.
That's good.
Which a lot of people don't necessarily know that.
That is correct.
Yeah.
Cool. Okay, so let's talk about bridge loans
Okay.
and maybe recasting.
Sure.
So those are kind of some products that are tools in the tool belt, you might say. Let's hear what you got for that.
Okay, well, first of all, let's talk about recasting because recasting is something that Guild does, and we do it for free for our customers, which is really nice. Recasting is basically taking a large payment. It has to be a minimum of $10,000 and making that as a principal-only payment towards the balance of your mortgage. This comes into play a lot when people are selling large items or possibly another home, and they're using the proceeds of that home to lower their overall payment on their current house. What happens is kind of like getting a refinance for free because what we do is we take that interest-only payment, apply it to the balance, reallocate the loan amount, and then base the new payment off the lower balance at the same rate. So
Nice.
And you're recasting it for the same amount of years as what they were.
exactly.
Okay, so they don't.
So if they've been in the year for
increase
7
the-
years,
okay.
then they just basically recalculate it at the same 23 years,
Gotcha.
but at the lower principal balance.
Okay.
I had a client.
That can make a big difference in your monthly payment.
Absolutely. I had a client who was up in Payson, and she had her primary residence up there. Then she decided to move down here with her daughter because she wanted to be closer to her daughter. The heat started getting to her. Go figure. So she said, I'm going back to Payson full time. I'm going to sell my home here in the West Valley. When she did, she had over $50,000 of proceeds. She applied that to her balance, and it dropped her payment by over $300 a month.
Nice.
Yes.
Huge difference.
It's a nice product that we can do.
Have you had, so in that situation, did she keep her home in Payson while she lived down here? Mm-hmm. Okay. So have you had clients do that to where, say, they own a home and then they're buying a new home, and then once they get the new home purchased, they sell the old home and they take proceeds and apply it to their new mortgage?
I have.
Does that make sense? Yeah. Okay. That's nice to know. Because, and so in that scenario, right, you would have to qualify for both mortgages
Correct.
Initially.
Correct.
Until you make that recasting.
Correct. But the
But
nice thing is that you can put a minimum down on the new home
Yeah.
Right.
and then immediately get rid of the MI, the mortgage insurance.
Oh, yeah. I hadn't thought about the mortgage insurance. Mm-hmm. Nice.
So
Very
there's
cool.
a lot of pieces in there that
There's
are
a
really
lot. There's
cool
lots of ways
for
that you can
recasting.
acquire new homes, and just it's just a matter of just knowing how to play the game.
So there aren't any lending fees associated with recasting
That is correct.
when you're already a client of Guild.
That is correct. We do it as a
But
service.
do they have to redo like escrow or anything
No.
like that?
It's just like making a large payment because that's really
Oh,
all
wow.
you're doing. The payment has to be
good
made
to know.
first.
Yeah.
Then once the payment is credited to the account, then they do the
Then they go
recasting.
back. Nice.
That's really cool. That's nice to know.
That is really nice.
See, so smart.
I know. Now, talk to us about bridge loans.
Okay. Bridge loans are a way that you can place an offer that is non-contingent on the sale of your home. What that basically means is you can still own the house that you're trying to get rid of and still put an offer in on the home, because what we're doing is basically giving you a cash out refinance on your current home to give you
Okay.
the amount of down payment you need to buy the new home. Now, Guild has to be the servicer of the new loan as well, because they basically close at the same time. But it's basically a 6 months interest only payment.
It's not bad.
And then after the 6 months, they refinance the new home? Or like, how does that, what does the timeline look like, I guess? Are they keeping the old home
They
in that scenario?
They have, excuse me, they have up to 6 months to sell that home,
Okay.
which
Once
is not
it's sold,
And once
yeah.
it's sold, it's sold. It doesn't really matter because we're not worrying about that. They just pay off. They can pay off the loan sooner than later if they want, but they have 6 months to pay it off. The bridge loan.
Okay.
So the bridge loan is basically on the home that they own, getting them to the new loan, and they have to use
Extra
Guild for the new loan.
That is correct.
Now I'm with you.
It's
Does it make
probably
sense?
more like extra down payment for the new home.
That's
So
exactly
you're
right.
using
Or
the
appraisal
equity
waiver.
from the existing property that they own to purchase the new property.
Correct.
And they have 6 months to sell the old property?
That
to
is
pay
correct.
off the bridge loan.
So
Okay.
you're basically paying back the down payment that you've taken from
Okay.
your existing home.
So you're putting the equity back in
Correct.
ish.
There
Okay.
we go.
But it's sold, so you don't have to worry about the equity going back in. It's just basically paying off
Yeah.
the money that was fronted to
Got
you
it.
to buy the new home.
And with so many people having so much equity right now,
Right.
it makes a lot of sense to do that.
Yeah, that is really interesting.
Well, especially if you need the cash to waive the appraisal or something,
Right, right.
which
So
Oh, yeah.
a lot of people do.
That's a good
Yeah.
point.
If they don't have a pretty good sized cash chunk in the bank for that.
kind of changes the game.
So
on
it's a
that.
cash out. So you get the cash from the refi or
Right.
bridge loan.
And you can
the
get
cash
anywhere
the
from
bridge loan.
40,000 up to 300,000 out of the existing home
Oh, wow.
for down payment.
Okay.
So there you go.
Yeah.
Okay.
I
Now-
haven't ever done one of that. Oh, well.
Now, you had mentioned something about waiving the appraisal. We don't actually waive the appraisal because the loan has to be secured by something. So there are times when the automated underwriting system will allow us to waive the appraisal if it's a very low loan to value, meaning say it's a 60% or a 50% home. Sometimes they will kind of scan the area of what's been sold and allow us to waive the appraisal. But in most cases, what you would have to do is basically waive the conditions of the appraisal.
Yeah, I think
That's
that's
what I
what
meant.
Scott-
really what
that's
you
what you
meant.
meant.
Okay.
Yeah.
It just
you're-
gives you,
the buyer
it gives
is
you
saying-
the cash to say, when you write the new offer, I got the money to cover this should there be a shortfall.
That is correct. So if the house appraises for 400, but you're selling it for 450, the buyer has to come in with that extra 50,000.
they have to bring
They
that
have to be
money.
clear that that's coming out of their pocket.
Right.
Yes.
On
Depends how
top
many
of
people
their
you're competing
closing
with.
costs and their down
Exactly.
payment.
It's an additional $50,000
Right.
cost.
Right. Yeah.
Yeah, I think people get really confused on that part of it. So
They get too excited and they're just not sure.
like
and-
everybody's doing it, I'll just waive the appraisal too. Well,
You need the money.
yeah.
Show me the money.
and a lot of people don't want to appear ignorant or stupid, so they're afraid to ask questions. So
True.
I say any questions you have, no matter how silly, even like what color ink do I use to sign the documents,
Yeah.
whereas
Yes.
most people are required to use a blue ink because it's harder to forge a blue ink, believe it
Right.
or not. So therefore, it's just, find out as much as you can, give yourself as much knowledge as you can to empower yourself to make better decisions.
And the only stupid question is the one not asked.
Absolutely.
Curiosity is a good thing.
And you guys are a great team, so you guys are going to bend over backwards to help all your clients. I've worked with you before, so it's just a matter of just hooking up with the right people to make sure that your destiny is solid.
Right, for sure, for sure.
Very
so
cool.
that's some really cool information. How about talk to us about rent versus buy? Because we have a lot of people who are in a position where they're paying, $2,000, $2,100 a month for rent. What would you say to somebody who's renting? Why is it important for them to actually be buying a house?
Well, in today's market, the prices are going higher and higher every day. Wouldn't you agree? Okay.
We're seeing it definitely increase.
So people that are sitting on the fence saying, I'll just wait till everything comes down, they're probably not coming down for a while, if ever. So they need to make a decision of if they're going to continue renting and basically paying somebody else's mortgage, or if they want to start establishing a firm foundation of their own financial history. And then think about, they're going to gain the equity, they're going to gain a financial cushion in case something happens. You can borrow the equity to possibly, like you said, another down payment, possibly medical emergencies, funding someone's college, things like that. You have something you can tap into that's a tangible asset. Also, you're going to gain equity through two ways, through principal pay down, meaning you're paying the loan down, but also appreciation. What was the appreciation this last year?
Last year we were on an average about 38%.
So when your
Bizarre.
when your house is doubling in value almost every 3 years, that's a lot of equity.
Yeah.
So
But if you
Even
look
if
at
it
the
isn't.
40, if you look
Yeah.
at 40 years of history, I mean, you're getting 6% no matter what across the board.
Right.
So,
and another thing with that is with the owning the home, you can guarantee what your payments are going to be.
Right.
You don't have to worry about your
Right.
landlord raising the price.
next year it's now
Yeah.
different. Yeah.
Right. The
Yeah.
only thing that changes would be property taxes, and that's fairly nominal most years. Right.
Yeah, we have no control about taxes. We all agree on that.
And you're paying your own mortgage, not somebody else's.
Exactly. And you have freedom to do what you want with the home. You can change out the appliances. You can change out the wall colors. You can knock out walls as long as they're not structural, obviously. You have some control and to do.
I don't have complete freedom of that. There's a wife that. Come on, Mary.
Well,
Well, I understand, because if I wanted to,
Audrey has complete freedom, and Lane does.
no, that's not true.
Ken and Tim don't.
If I wanted to paint my house purple,
Tim might
There
have
might be
something to
some
say
pushback.
about it.
I would get a pushback.
I want to see Hudson's face when you do that.
Well, he's in a black phase right now.
Okay.
So everything's black. Yeah.
There also may be some
Yeah.
tax benefits as well, but everybody's a little bit different. So I'm not a tax expert.
Right, you'd have to
You
check
definitely
with
need a tax.
Yeah.
Check with your tax expert
Right. Oh, for sure.
because things change all the time with the government.
Well, so on an average, like an average house price in Arizona is about $400,000. So what would it look like if somebody wanted to actually buy a house? What's their mortgage at? Where would that all look like?
Say they're putting 5% down. That would basically be $20,000. So
Okay.
anytime you put less than 20% down, you have to pay something called mortgage insurance. Now, you can do that two ways. You can either pay it on a monthly basis, and then once you have 20% equity, meaning 20% ownership in the home, you can ask for that to be removed. And it's usually done with an appraisal. And as long as you can prove that you have the 20% equity, they'll remove that. If you don't ask about it, they're going to wait till at least 25%. They're going to get as much of the premium as
And I see
possible.
like they usually look at it for 10 years. They know by 10 years you'll have it. But I tell people don't wait 10 years for that.
There's also a single premium aspect of it. So if you want to get rid of it fairly quickly, basically have no mortgage insurance added to your monthly payment, you can do that in a one-time payment. So I calculated before I came over here, say the rate was 4.875%. And I'm just using a random rate here. With a $380,000 mortgage, no points are added to that, meaning you're not trying to buy the rate down or anything. You're keeping your cash to possibly pay down that mortgage insurance up front. So if you wanted to pay the mortgage insurance up front, it would be $6,080,
Okay.
a one-time payment, but you're not having that monthly payment of $98 every month for the next
Okay.
potentially 10 years.
years,
Right.
yeah.
So you're looking at a $400,000 home with 5% down, adding an estimated, say, about $250 for taxes and insurance. You're looking at $2,261 a month. How many people can rent a 3-bedroom or 4-bedroom home, 2-bath, for less than $22,000 to $2,500 a month right now?
Right.
Yeah.
So you're getting in, for about the same, if not less.
Yeah.
And then if you were to be adding that mortgage insurance and monthly, your payment's going to go up to $2,359. So it's fairly comparable. But the nice thing, is that payment is never going to go
It's
up,
never gonna
whereas
change.
the rent.
Right.
Well, and
potentially go up.
actually, and you're gaining equity because even though I know at the beginning of the amortization of a loan, the principal portion of your payment is smaller, but you're still paying down that original loan amount, and so you're gaining that equity.
I use a lot of food analogies because people understand food. If you think about a 30-year mortgage as a triple scoop of ice cream, the interest is the ice cream and the principal is the cone.
Okay.
How far do you have to eat down that before you're starting to take large chunks out of the principal? So it's going to be, probably 15 years or so before large chunks are starting to come out of that, unless you start making extra principal payments. You can do that as well. If you make one extra principal payment a year, that takes about 7 years off a 30-year mortgage, which is nice as well.
That's amazing.
And you don't have to do it all at once. You could do 1/12 of the payment. So say your payment is $2,400 a month. You make an extra $200 a month to your principal.
Easy peasy.
Right.
Yeah. Most people stop going to Starbucks and you'd be able to take care of that. Sorry, Starbucks. But yeah.
Whoop. Well, this is so you can have it at home.
Yeah, you can have it at home, and that way you don't have to.
So you can still.
The K cups are more.
I'll never look at ice cream the same again. Man.
Really? I love it.
There
I
goes
love
that indulgence.
All right. So yeah, so to me, like
That's
like
awesome.
when you're meeting people who are renting, and typically they're young kids still, they're coming out of college and stuff, but I always try to give them that little bit of heads up of if there's a chance we could get you into buying a house. Would you be interested? And they always look at me like kind of like that dog look, and it's like they don't see the value. And so you just want to kind of educate them as much as you can as to why there's value to a home ownership.
Absolutely.
Like I've had somebody argue with me, well, if I want to move, I can't just right away move. I have to actually sell. Well, yeah, you can right away move because then you could rent that place and they could be making your mortgage payment, right? So so it's not like there's a hindrance to own a home.
This is true.
Yeah.
And sometimes I've had college students or college graduates ask their grandparents or their parents for their inheritance up front.
And sometimes that actually makes a big difference.
So they can get their 20% up front, so there's no mortgage insurance. They're qualifying at a lower rate. They're in an overall better situation, and they have 20% instant equity.
And what mother or grandmother doesn't want their child to have a house? I mean, that's a huge thing that you're giving them.
Yeah.
So yeah.
These are some good friends of mine that actually gifted their son the equity up front. He goes, and this way we can guarantee he's not moving back in.
That's true.
Insurance.
Now, that's a good idea.
See, there you
That
go.
is-
Parent insurance.
That is funny. So yeah, so we've
Empty nester insurance.
Yeah. Oh, thank you. That was
empty
it.
nest insurance.
There you go.
Oh, we should create a marketing plan.
We can do that.
I love it.
Well, because you can do there's like the gift, you can do the one-time gift as well.
$10,000,
gift.
yeah.
Yeah.
Or 12, I think it
Isn't
just
it-
went up to 12.
That's one.
Oh, really?
That's
Yeah.
once
I didn't
per
know that.
year.
Yeah, it's
Yeah, I think it's annually.
That's annually. But yeah, so well, we need an estate attorney here next. Maybe.
I think we can make that happen. Okay, so
Very
really,
cool.
I think we've kind of covered a lot of it. This has been amazing information. We talked about waiving the appraisal, what that looks like for a buyer. We've talked about rent versus buy. We've talked about bridge loans. We've talked about recasting loans. What's the difference between second homes and investment properties? This is
Anything else,
awesome.
Mary, that you're seeing currently with lending that we haven't talked about?
It's just basically you have to coach your buyers that they need to get off the fence. They need to start making decisions because the market is not going to wait for them anymore.
The interest rate is changing, and once it starts to change, it's going to affect what they can afford.
Absolutely.
Yeah.
Absolutely.
Yeah.
Because it affects their total debt to income ratio. With FHA and VA and USDA, the government-sponsored loans, those are hard to get approved right now. People want the conventional loans. So with conventional rates, the rates are determined by the amount of income that you make, your credit score, the debt-to-income ratio, the type of property. So there's a lot of things that go into the calculation of the interest rate. Whereas with a government rate, it pretty much is the rate. So, and you have to have so much credit history in the past as well. They want to see at least 2 years of history. They want to see at least 3 types of trade lines, meaning 3 types of accounts, possibly a car loan, a student loan, a credit card, things like that. They want to see that you're able to pay your bills responsibly. Think of it this way. If I want to borrow $1,000 and I can't even pay back my $30 a month, why would you give me $300,000 and expect me to pay back $2,000 a month?
Yeah.
So they just basically want to see, it's common sense. It really is. It's just you have to break it down to the basic information so that people can understand it and apply it to their lives directly.
And does Guild have any kind of program? So say somebody is curious about, this is my financial picture and what does this look like and what are things I can do to improve this? to move toward homeownership? Do you have
Absolutely.
things like
I have
that?
clients that I work with for 6 months to a year in advance.
Yeah, you've worked with some of my clients for a couple
Absolutely.
months now. Yeah.
Absolutely. And it's basically to improve their credit situation. If you're going to get at least a 740 credit score, you're going to get some of the best pricing out there. If you're below 700, the mortgage insurance is going to be a lot higher if
Okay.
you have to have mortgage insurance. So there's things that affect the different aspects of the mortgage. Of course, depending on where you live, the taxes can be higher. If you're living in Ahwatukee, it's going to be a lot higher than living in parts of Mesa. So
Yeah.
it just depends on, location.
Right.
And then what you want insured, you basically have to have the structure insured because, and then the lender is the first person on the insurance, obviously, because they're
Right.
the lien holder.
Okay.
So there's lots of things you just basically, I try and break down it to every aspect of it so that there's no ahas, there's no gotchas. When they're looking to sign their final papers, there's no fear of signing the paper. They know exactly what's on the paper and why it's there.
Right. Okay.
Cool. All right. Well, thank you so very much for all your time and giving us
Absolutely.
all this information. We can't tell you how much we appreciate it.
Thanks
It's
for
been very valuable. Very
You guys are
valuable.
great to work with, and I'm happy to be here.
Thanks, Mary.
Awesome. Well, if you guys have liked and enjoyed our little episode here, we want you to like and subscribe to our channel and go to teambeery.com for any of our resources. We're going to have some handouts and things that are going to be fun on there. And always use a very good team.
Bye, y'all.
Bye-bye.